When you invest in a mutual fund, an ETF, a hedge fund, or any other type of managed investment, you are allowing a company to take your money and hopefully provide you with a positive return. Investors know the benefits of diversification, even though so few actually are diversified. And yet, we look at the majority of these managed funds and see how little diversification there actually is. What should you do with your money? You came here for the truth, so let me unveil that for you. Today we're going to look at what's happening right now with these managed funds, talking about consolidation. Then I want to talk about average individuals and how they are affected by this, all right? So let's begin with this. Investco QQQ Trust. You may have heard of this before, a very popular ETF that's out there. And I found this to be very interesting. I wanted to bring it to you and really highlight this in this video today. Assets in the top 10 holdings is over 50%. So what does that mean? If you look at the top 10 holdings, that is literally half of the portfolio of this fund, 10 stocks, but it gets even worse. Okay? So we're looking at Apple, Amazon, Microsoft, Facebook, Alphabet, and you can see Netflix down here. These are the top 10. But if we look, what are the top 5? Well, we have our FANG stocks. Basically, the same group that we've always been seeing. If I were to add these up, approximately, let's say 10%, 20, 30, 35, add these together, just in the top 5, let's say 5 companies here, we're looking at almost all of that 50%. So it's not even really 10%. Most of it is made up of just 5 companies. When I see this, I have to be worried because it's not diversified. I could simply buy these stocks, not pay a management fee, not worry about what they're doing on their end. I could just buy the stocks myself. I pay a little fee when I want to buy it. I pay a little fee when I want to sell it, but I don't have to worry about anybody else. And I think that's the way that people need to be dealing with their investments. Manage it on your own. I know an ETF, you can simply sell or buy, but we don't know what's happening behind the scenes. Do we even know specifically that all of this has been accounted for? Sure, there are audits done regularly, I'm sure every quarter, probably. But look at what happened with GLD and SLV. They found out in the fine print that they may not actually have all the gold or all the silver that they say they do. Sure, that is audited. Yes, I get that. But we really don't know. I don't know. I don't trust them. It's called Investco QQQ Trust, but I'm going to scratch off that word trust because personally, I can't. Now, this is the type of thing that I see people talking about all the time. I'm diversified. I own Facebook, I own Apple, I own Amazon, I own Google, and I own Netflix. I've got them all. I've got all different types of assets. Well, of course, you know that I'm being silly here, but I really want to highlight this because today, as it stands, there is such a heavy consolidation into just a handful of stocks. I've never seen this before in this bull market. This has been definitely where all the money has been heading, and I'll show you that right here. Comparing the NASDAQ 100 index to the NYSE. So you could see both of them came down here leading into February. We saw that drop late January into February. And then, the NYSE been trading in this range here, as you'll see for yourself. However, take a look at what has happened with the NASDAQ 100. And I'm sure if we just go to the FANG stocks, this would be even more so exaggerated. And that's not good to see consolidation. It worries me. It worries me especially at a time when you've got all of these different funds that are being set up, all the mutual funds and all the different hedge funds and all this different investments, and they go in to further and further consolidate. Why? Why would they do that? Why not stay diversified? Well, quite frankly, they need returns. That's what their goal is, to achieve the maximum amount of returns so their clients are happy, so they get more assets under management, it looks good on their part, and so on. Okay? So when you have better returns, it makes more money. Makes more money for you directly, makes more money for you indirectly. And we've got this little tiny predicament, okay? Because when you consolidate, that also spells disaster in the future, because when things start to decline, you have this snowball effect. Well, suddenly if you had, let's say, 100 stocks in your portfolio making up that 50%, now today you only have 10 stocks. We have to be worried about this. We really do. That's why you should definitely be managing your own, but you need to hedge your bets. I just covered this in a video recently. Your pie chart for what your investments should not be looking like what most people's do, and that is paper, and guess what? Precious metals? No, paper. Okay. So we need all 4 asset classes, okay? We need all 4. Paper's one of them that may at some point be good, but anyway, paper. Within that paper, most people have just FANG stocks. This has become the new trend. Even the big corporations are going in this direction. More and more of their portfolios being made up of FANG stocks. All right. We need to be splitting that up. Yes, you want a little bit of the FANG stocks, but you also want to diversify. You want to own some other industries, not even in the tech industry. You want to own maybe something that would take advantage of commodities, right? We saw oil going from $30 a barrel and it doubled. All right. Was anybody taking advantage of that? No, they were consolidating more so into the FANG stocks. Don't consolidate, diversify, especially as the market heats up. You want to be diversifying. Hey, if you don't make all the gains that everybody else could have, that's okay, because you're diversifying, you're becoming stronger. That's what it does for you, okay? No more ranting, okay? Move on. Look at this. The flash crashes that we've experienced in the recent past have been amazing to see. It's not just one time, it's not just 2 times. The big flash crash, everybody knows about it. I covered it here on this channel multiple times. U.S. equity flash crash, May 6th, 2010, 6% down. The market crashed 6% practically instantly, and you could see the chart here, how it looks. A 6% drop in a flash, that hurts a lot of people. That starts to trigger algorithms. That really does make a mess. Okay, sure, things come back up, and it gives you the explanation for each one. I'm not going to get into it. But what I would tell you for all of these, whether it is, this period of time with the treasuries, whether it is the sterling, it happens. It happens with equity markets. It happens with currencies. Happened with the VIX. It happened with anything. Anything could be affected by it. Why? Because we have high frequency trading, we have computer algorithms, and they are managing this market. Human beings don't manage the market. You as an individual trader are insignificant to what happens in the market on a daily basis. Nearly 100% of all trades are done by computers today, and that is messing everything up. What that means is that we could have a point in which your accounts are locked up. Why? Because there's a flash crash, they shut the market down. When they reopen, what will happen? Will that flash again? Will they put a stop in place? Okay, we're not going to let it fall more than 20% in a day, 10% in a day. Who knows? But what happens when the market reopens? People are uncertain about that. They're thinking, hey, look, nothing's going to happen to Apple. Nothing's going to happen to Google. They're safe. The billion-dollar investments are in there. I don't have to worry. What you have to worry about is a lot different than what the big boys have to worry about, okay? Number one, that's not their own money. They don't really give a damn. Number two, you as an individual have these... Basically, you're holding less of a pile of money. You got to hold on to every last dollar. You're not dealing with literally hundreds of billions of dollars that are going into these companies. You have to manage it properly, and you have to be very, very careful as to what you're doing. This money could evaporate instantly during this whole tightening cycle by the central banks. Counting down the 6 longest bull markets, the current bull market has been quite impressive historically. There's no doubt about that. I mean, you could see where we have gone, the post-crisis bull run as they describe it here. There's not much to say other than, by the way, if you want to see this infographic, let me zoom out for a second here. You could see it. It's actually quite good if you're interested to see how they rank the different bull markets. But looking at this here, I just wanted to show you the fact that we are in a time frame when everybody made fun of this period of time. Not made fun of, but pointed to it as being ridiculous. Oh my God, the tech stocks they went crazy. This is so ridiculous. I personally visited an office that suffered after the dot-com boom and bust, okay? There was one guy in the entire office. They still had the lease on the place. There was only one guy. The trading desk was empty. The offices were empty. All the cubicles were empty. There was just one guy working in there. That's it. That's it. That's what happens when people overreact. And everybody pointed at it like, oh, look at this. Look, this is silly. What a ridiculous, PE ratios and things like this. It's not just about PE ratios. It's about consolidation as well. And when the Fed dried up the liquidity, guess what? The market came down. It happens all the time. Yes, they point to the dot-coms. Yes, they point to the housing crisis. But the Federal Reserve, let me repeat, the Federal Reserve creates all recessions. Moving on, okay, quickly here. Looking at Las Vegas home prices, guess what? Following directly in line with interest rates. The same things happening today. We are seeing them rise together, and they will fall together as well. There's a lot of speculation taking place in Las Vegas. I think the number was something like 13.4 or 13.6% appreciation year over year. That's absurd in real estate. I mean, even in a stock, you would consider that to be an incredible return. Wow, I got 13% of my money year over year. Amazing. Okay, the most fund managers can't even get half of that. So you're looking at this. 13% in real estate? Insane. But as I've said here, this is a direct correlation in between interest rates rising and Las Vegas home prices. You need to understand that. Americans, this is funny here. Americans still aren't saving despite the, booming economy. Yes, it is booming. That's right. That's what they're telling us. Well, they're never going to save, and that's just a matter of fact because they feel that everything is just fine. We're seeing the savings rate declining, okay? If I were to show you the savings rate, I've shown you it before, but basically for decades and decades, the savings rate has moved down. Now, there was a brief period of time where the savings rate moved up, but it basically just continued its trend back downward, and that spike in here was when everybody was uncertain about the financial crisis. It lasted days practically. But anyway, we've been moving down yet again. And that's the reason why this has done so is simply because what's the point of saving? You're not going to make any money by keeping your cash in the bank. It just doesn't work like that these days. All right, quickly. All right, collections by tax type as a percentage of total state tax revenue collections. I think it's important to understand which state taxes you at what. And a lot of people, number one, they could move from one state to another and save a lot of money. I know many people who I've talked to over the years who have done just that. It's too expensive to live here. I'm moving. That's what happens. But businesses move as well. They move physical locations, or you as an individual, if you have a corporation, you don't need to have it and, in the state that you are operating in necessarily. You could open that in Nevada, you could open it in Delaware. You can do things that are not possible for the average person who doesn't look into it, doesn't ask the right questions, who doesn't have the right accountant. And that's important. So I just wanted to bring this to you. If you're interested, you could see it for yourself. I just wanted to move on and show you that very quickly. Guess what? The Obama Presidential Center is to cost Illinois taxpayers nearly $200 million. This is what your tax money goes to. It goes to build things that people don't want, don't need, and don't care about. Who are the disrupted and how are they responding? So I thought this was quite an interesting chart here to look at how the industries are being disrupted by these relatively new or very new companies, whether it's cable TV and media. Look, Facebook, Amazon, Netflix, Google, they're destroying some of these traditional dinosaur media. IT hardware and software services, Amazon, Microsoft, Google, and it just goes in to show us how, yes, we have had these companies come in and totally change the way things work. Does that mean that all of your investments should be in these companies because that's what the chart shows us, and I could look at the 1-year chart and therefore I should be investing in these companies? No, you would want, if you're into paper stocks, you would want exposure to these companies. I'm not denying that at all, but when you have 100% of your money in any one thing, you've got a big problem ahead of you. Okay, last but not least, wanted to just cover this very quickly. Alexa, I can trust you with my checkbook, right? Right. So this is actually going to tie in with all of these different all these different robotics, automation. They're tying in now, they're getting into people's banks, and I think that is going to be a problem for people because of all of the hacking possibilities and all the mess that this will in fact create. Okay, don't trust them. Trust me. Trust me? No. Don't trust them. Don't trust anybody. Let me put it that way. If you found the video informative, please give me a thumbs up, and don't forget to check out the links in the description. Take care.